Chapter 7, Job Costing. Now that we're comfortable with CVP analysis and fixed versus variable costs, we can extend these concepts and apply them to different business conditions. This chapter is going to focus on jobs. We can do job costing or we can do process costing. Job costing is where we have an easily distinguished cost object. These cost objects are different from each other. So different jobs, such as perhaps you're an accounting firm and you provide different services to different clients, or other examples might be a custom home builder. Anything where the products or services are going to be substantially different for each client, we're probably going to use job costing. Compare that to process costing, which is what we're going to cover in the next chapter. Process costing is where you have something like a manufacturer and you create multiples of the same type of item that are indistinguishable, such as cans of paint. You can't tell one can of paint from the other if they're the same color. Or maybe a bakery like Little Debbie or Hostess. You're not going to be able to distinguish between each little cake. They're all supposed to be the same. To illustrate what job costing looks like, we're going to talk about a company called Gupta Designs. This company manufactures furniture for homes and offices. And in this example, we're going to talk about Gupta's 3 different jobs that they're working on. This is what the flow of raw materials looks like. So raw materials can be classified as either direct or indirect materials. Direct materials are going to flow to each specific job, and then at the end they're going to be consolidated into work in process inventory. Whereas indirect materials goes to overhead, and then overhead will later be allocated. Labor is the same thing. Labor can be split into indirect labor and direct labor. Direct labor can be tied to the different jobs, which then flow into work in process, whereas indirect labor is classified as overhead, which is then allocated to work in process or other inventory accounts or cost of goods sold. In this example, overhead is allocated to the different jobs and then allocated to work in process, and they use a predetermined overhead rate. So there's a few different ways we can allocate overhead, and we'll talk about the different ways, but in this example, we're using the predetermined overhead rate. And we'll discuss how to calculate that rate in an upcoming slide. So in this example, we have 3 inventory accounts: raw materials, work in process, and finished goods. And these are the beginning balances on January 1st. 30 grand, 41 grand, and 27 grand. This is what a T account looks like. So we're going to be working with T accounts in our homework. So hopefully you remember how to use those types of accounts. BB here stands for beginning balance. So as we discussed on the prior slide, the materials inventory started out with 30 grand in beginning balance. Accounts payable had 17 grand in its beginning balance. Accounts payable is a liability. So when a company has an accounts payable, that means that they purchased inventory or some other asset from a vendor. They didn't pay cash, so they put that purchase on account. Here they say that Gupta purchased $135,000 of raw materials on account. So the journal entry for this is going to be debit materials inventory for $135 and credit accounts payable for $135. So that's what you see here. You have a debit. Debit means the left side of a T account. We're debiting materials inventory for $135 and we're crediting accounts payable for $135. So remember, your debits and your credits always have to equal in a journal entry. Next, Gupta used 12 grand of direct materials for job 1203. And they also started jobs 0101 and 0102 and used direct materials of 102 and 15 grand. So if you do 12 grand plus 102 plus 15, the total you get is 129. So you see here that to take inventory out of the materials inventory account, we're going to credit it because it has a natural debit balance. To reduce inventory, we're going to have to do a credit. And we're just going to transfer it to the work in process inventory account. So remember that it flows from raw materials to work in process to finished goods. So our journal entry is going to be a debit to work in process and a credit to materials inventory, which is raw materials. Now you can have a subsidiary work in process account. So what this shows us is which jobs work in process belongs to. So for this 129, we have 12 grand of it that goes to job 1203. We have 102,000 that goes to job 0101, and then we have 15,000 that goes to job 0102. So again, 12 plus 102 plus 15, you get the 109. Direct labor is going to be similar. We incurred 98 grand of direct labor. 16 grand goes to job 1203, 71 grand goes to job 0101, and 11 grand goes to job 0102. So 71 plus 11 is 82, plus 16 is 98. So first we record our journal entry, which would be wages payable credited of 98 grand and work in process inventory debited of 98 grand. So remember that direct labor becomes a component of inventory, so it becomes tracked as an asset. Now this 98 grand further breaks down into subsidiary accounts. So you can see here that you can split out that work in process inventory into these three jobs, and they all add up to the amount in the work in process control account, which is the main account here. So the 41 beginning balance in the control account shows up here. Then if you take this 129 here, these three numbers are going to add up to 129, 12 grand, 102 grand, and 15 grand. And then the same for the 98 grand. Now manufacturing overhead is going to be a little bit different. Gupta incurred overhead comprised of 12 grand of indirect materials, 95 grand of indirect labor, 13,750 of utilities, 5,000 in prepaid expenses, and 11,200 in factory depreciation, which adds up to 51,450. So how do we record these amounts? So these amounts go first into the manufacturing overhead control account. So this control account, remember, we're going to distinguish between manufacturing overhead control and applied manufacturing overhead. When we apply overhead, we're going to use the predetermined overhead rate. So it's going to be an account that we use estimated figures to come up with the amounts. For manufacturing overhead control, on the other hand, we use actual expenses here and also depreciation. So all these expenses that we looked at the prior slide, they all get debited to manufacturing overhead control account. And then they're credited accordingly to the accounts that they relate to. So here's the 5,000 prepaid expense, the accumulated depreciation of 11,200. You can match up here, and then the 12 grand of materials inventory. So you can match up all the numbers. Remember that anytime you have a debit, you're also going to have at least one credit. You can have multiple credits or you can have multiple debits, but they all have to add up and balance at the end. So now we talk about the predetermined rate. The predetermined rate is going to be an estimated amount. So we try to predict what our estimated overhead costs are going to be and divide that by our estimated activity for the allocation base. So both numbers are based on estimates. Why do we use a predetermined rate? Well, this is the difference between financial accounting and cost accounting. Financial accounting is easier in a sense because your numbers have already been recorded and incurred, and then you just have to crunch the numbers. Cost accounting is different because in cost accounting, you have to predict numbers. You have to predict them so that you can try to operate your business efficiently and effectively. So that's why you have to use a predetermined rate to try to reach numbers that are reasonable, and then you can operate based on those numbers. And then at the end of the period, you can adjust those numbers for actual numbers. And we'll cover that as well. So for this example, before the year begins, the company estimated that manufacturing overhead would be $600,000, and they also estimated that direct labor costs would be $1.2 million. And they want to allocate using direct labor cost. So it's a pretty simple formula. You just take that $600,000 divided by $1,200,000, and you get 50 cents per direct labor dollar. So that means that anytime you have $1 of direct labor cost, you're also going to apply 50 cents of overhead. So remember, when you determine what the rate is going to be, you have two estimated amounts, the estimated overhead and the estimated allocation base. Now we look at the next slide, and we see that when we actually apply the overhead, we're using actual numbers. So in this case, job 1203 had actual direct labor cost of $16,000. Job 0101 had $71,000, and job 0102 had $11,000. So these are actual numbers. So you take the actual numbers, multiply it by your rate, and you get the overhead applied amounts of $8,000, $35,500, and $5,500. So we continue with our example. Gupta finished jobs 1203 and 0101 and transferred them to finished goods. So the total cost of job 1203 was $77,000, and the total cost of job 0101 is $208,500. So these amounts are in our work in process inventory and now we're transferring them to finished goods. So here's what the journal entry looks like. Remember, to reduce an asset account, we have to credit it. So we're going to credit work in process inventory of that $77,000 and the $208,500. And then we debit the finished goods inventory for those two amounts in the journal entry balances. Next, it tells us that we sold these jobs for $35,000 and $95,000. So what does that journal entry look like? So when we sell goods, we have two entries. Anytime you sell goods, first you have to take it out of finished goods inventory. So looking at job 1203, we took the $77,000 out of finished goods inventory because it's already sold, and we debit cost of goods sold, which is an expense of $77,000. Next, we record the sale. The sale of job 1203, we sold it for $95,000. So we made a profit of $18,000, and we're going to recognize revenue of $95,000. Remember that revenue has a natural credit balance, and accounts receivable, which is an asset, is going to have a natural debit balance. So that's how you record a sale. Remember that there's always two entries anytime you're selling a product or service. This slide talks about the different overhead accounts that we have discussed in a prior chapter. Remember that we have manufacturing overhead control. The control account has all actual expenses, and the applied account is based on the predetermined overhead rate. So again, when we have actual expenses, that gets recorded initially in the overhead control account. And when we're applying overhead to these jobs, we're going to use the overhead rate, the predetermined rate, and we're going to record that under the applied manufacturing overhead account. Now, ideally, these two accounts are going to balance at the end of the month, but in reality, that never happens. There's always going to be a degree of overhead that's over-applied or under-applied. So at the end of the month, we balance these two accounts together, and if we over-applied overhead, then that means that our expenses are too high and we're going to have to reduce them a little bit. Or if we under-applied overhead, we're going to have to increase our expense accounts. So again, under-applied overhead means that we incurred more overhead than we allocated to these jobs, and over-applied overhead means that we allocated too much. So our predetermined overhead rate might have been a little bit high. So this is what it looks like when we have these two accounts. So manufacturing overhead control, again, it's going to record all the different expenses that we incur in the period. Usually it's a month. And so in this case, we incurred $51,450 of overhead expenses. We only applied, however, $49,000 in overhead expense. So we multiplied direct labor dollars by that predetermined overhead rate, which gave us a $49,000 amount, but that was not sufficient. So we underapplied overhead by $2,450. So how do we fix that? Well, one way to fix it is to increase the cost of goods sold account. Again, cost of goods sold is an expense. So since we underapplied the expense by $2,450, we're applying it now. So now, instead of $104,000 of cost of goods sold, it's $106,450. So once we apply that amount, now our applied manufacturing overhead adds up to $51,450, which is the same as the control account from the prior slide. So now both accounts combine to equal zero. So again, one way to handle the underapplied manufacturing overhead account is to increase cost of goods sold. But as we look at the next slide, some companies will prorate that amount not only to cost of goods sold, but also to work in process and finished goods. So this is how Gupta Company would allocate to those three different accounts. At the end of the month, they add together the ending balances of the work in process, finished goods, and cost of goods sold. That came up to $344,000. And then they calculated the percentage of each account to the total. So $31,500 is 9.2% of 344. Finished goods inventory of 285 is 60.6% of the total 344. And then cost of goods sold 104 is 30.2% of the total of 344. And so we're going to allocate our underapplied overhead according to those same percentages. So as we see here, work in process inventory was 31.5. This is the T account. We're going to allocate this 2450, which is our underapplied amount. We're going to multiply it by the 9.2%, which, remember, that's what the work in process amount comprised of as part of the total. Finished goods inventory, we're going to allocate 60.6% of that 2450. Cost of goods sold, we're going to allocate 30.2% of that 2450. And so when you add up the 225, 1485, and 740, you should get the 2450, which was underapplied. So again, there's two ways that companies will generally apply this overhead. One is they'll just put it all to cost of goods sold, but the second way is what we just covered here. And this way is a little bit more accurate, but again, you always have to balance the cost of accuracy versus the benefits. Sometimes it's a little bit too much hassle to try to allocate things perfectly, and so some companies settle for shortcuts like allocating this underapplied overhead all to cost of goods sold. This slide talks about the different ways we can allocate these costs. So some companies will determine the cost of a job using actual direct materials and actual direct labor, and then they will apply overhead using the predetermined overhead rate and the actual allocation base. So that's what we just did in the prior slides. We used this overhead rate, which is based on an estimate, but we applied that rate to actual direct labor cost figures. Other companies will determine the cost of a job using direct material, direct labor, and applied overhead using the actual overhead rate and the actual allocation base. So here's the difference. This one is an actual overhead rate, and this one is the predetermined overhead rate. The difference between the two is you can use normal costing before the period starts because it's based on an estimate, but actual costing, you have to wait till the period is over so you can determine what the actual overhead rate is. So if you really need estimated figures to be able to operate efficiently, then you're going to have to use the normal rate. And if you can wait and it's not so urgent to get estimated figures out there, then actual would give you a more precise answer. And then you have a third method, which is standard costing. And here you have a lot more estimated numbers. You have estimated direct material, estimated direct labor, and you're going to apply overhead using the predetermined overhead rate, which is based on an estimate, as well as a standard estimated allocation base. So standard costing, you're using all estimates to come up with your amounts, and then you're going to have to adjust the figures to a greater degree at the end of the period. Service organizations. These organizations also can do job costing, and the concepts are the same, but the names of the accounts are slightly different. So the concepts, just keep those in mind. They're going to be very similar to the manufacturing example that we just did, but with different names. So instead of cost of goods sold, we're going to have cost of services billed. And this slide shows the flow of labor in these service organizations. It's very similar to what we did in the manufacturing example. Labor is going to be split into direct labor and indirect labor. Instead of jobs, they're going to call them contracts. It's the same concept, though. You're allocating these costs based on different jobs, and then ultimately it's going to flow into work in process, and that's going to be the same thing with overhead. Overhead is going to be allocated to those jobs as well. So those are the concepts of Chapter 7. Hopefully this lecture helps you get through the homework.